Warren Buffett and Greg Abel are quietly pulling money out of the stock market. Berkshire Hathaway is sitting on $397 billion in cash. To build that war chest, they are actively dumping their most famous winners. Over the last year, Berkshire cut their massive stake in Apple by more than half. They are executing the exact same strategy in the financial sector, rapidly liquidating large portions of their long-held position in Bank of America. $397 billion is more money than the entire gross domestic product of countries like Hong Kong or Norway. It is more liquid capital than Apple, Microsoft, or Nvidia currently hold on their balance sheets. And they are building this pile during a 14-quarter selling streak. While everyday retail investors aggressively buy AI hype and chase the S&P 500 to historic highs, the greatest capital allocation machine in history is moving in the exact opposite direction. Mainstream media often frames this as Buffett simply preparing for a routine crash, but the math behind this mass liquidation points to a deeper, structural problem with current stock prices. At the most recent annual meeting, Warren Buffett passed the operational torch to new CEO Greg Abel. When discussing the current state of the U.S. financial system, Buffett described it directly as a casino. He bases that assessment on a single calculation he created decades ago. It takes the total value of all public U.S. stocks and divides it by the country's gross domestic product. This chart shows the historical readings of that exact formula. Buffett has stated that any reading over 100% means stocks are expensive. Historically, whenever this line crosses 200%, the market enters a dangerous speculative state. Right now, that number has spiked to 227%. Stock valuations have completely detached from actual economic output. If the numbers clearly show an overvalued market, you might wonder why Berkshire is simply sitting on the sidelines instead of aggressively betting against it. If an individual investor sees a good company drop 15%, they can buy shares instantly. They are nimble. Berkshire Hathaway cannot operate that way. With a market cap hovering around $1 trillion, they are a massive megatanker. They physically cannot execute small trades without instantly distorting the price of the stock they are trying to buy. To actually move the needle for their shareholders, they are forced to take massive multi-billion-dollar stakes or buy entire corporations outright. Because of that sheer scale, a standard 10 or 15% dip in the broader market doesn't make those massive targets cheap enough to meet Berkshire's strict valuation rules. Their size traps them. They cannot deploy capital effectively until a systemic, once-in-a-decade panic creates deep, market-wide discounts. Until that dislocation happens, they wait. The term cash pile is actually misleading. Wall Street often assumes this money is sitting idle in a vault, slowly losing purchasing power to inflation. But the vast majority of that $397 billion is parked directly with the U.S. government. Berkshire holds this capital in short-term U.S. Treasury bills. Right now, those bills are yielding between 4 and 5%. At this volume, that yield generates an estimated $15 to $20 billion a year in pure interest income. When you get paid billions of dollars guaranteed by the government, the psychological pressure to risk capital in an overpriced stock market completely evaporates. The high interest rate environment has collapsed the cost of waiting to zero. For Berkshire, extreme patience is a highly profitable, active strategy. Holding this much liquidity in an expensive market provides one specific advantage: optionality. Berkshire is perfectly positioned to strike whenever the environment changes. Moving forward, CEO Greg Abel has 3 realistic ways to deploy this capital. Path 1 is slow and steady. Berkshire executes methodical stock buybacks and targets small, calculated deals over a long timeline. Path 2 is the elephant hunt. They wait for a severe market crack and use the war chest to execute a single, massive acquisition that alters the entire trajectory of the company. Path 3 is the nuclear option. If no viable targets present themselves, Berkshire could eventually return that massive pile of capital directly to shareholders through dividends. Which of these routes Greg Abel chooses when the market finally breaks will completely define the post-Buffett era of the company. For everyday investors, the lesson here starts with discipline. You have to stop yielding to the fear of missing out and chasing momentum just because stock prices are rising. Instead, focus your attention strictly on quality businesses that possess strong competitive moats and wait until they trade at reasonable valuations. More importantly, you can apply Berkshire's exact strategy by proactively building your own personal liquidity reserve. Holding dry powder shifts your leverage. A market crash stops being a terrifying event and becomes a position of absolute power, allowing you to buy great assets at steep discounts while everyone else is panicking. Berkshire's $397 billion stockpile proves that extreme patience isn't driven by fear. It is a calculated, offensive stance. The only question is whether you will have the cash ready when the opportunities finally arrive.